Obviously, the best case scenario is when you can redo everything at a real low rate, but that option's not with us anymore. So there's a lot of different things we can do, right, or think about, but there's a couple sort of very simple things. One is, for the last 10 years, if someone wanted to borrow money, from the excess equity they have in their house, it was, for a business or for additional working capital, whatever they might need, the formula was really simple. Refinance your first mortgage because the interest rates were so low for so long, right? And then just get the extra money out of the equity of your house by doing that. Now it's a little more complicated because you don't want to disturb, right? Interest rates are higher now and look like they're rising, right? With some inflation and all that. So this is probably not a time you want to get rid of the low rate first mortgage you have. So it's just the time, if you need money and you want to use the equity you have in your home, it would just be the time to do a home equity line of credit as a second mortgage, so that you don't have to you don't have to disturb the first. Obviously, the best case scenario is when you can redo everything at a real low rate, but that option's not with us anymore. So if you need to do it, just leave the first mortgage in place, and you can borrow on a home equity line. That's one thing. That's sort of a little more personal than business, but a lot of people use that for business, okay? Another thing is, in one sense, the economic activity has picked up from the standpoint of, there's more money chasing fewer goods, right? So there's this pent up demand for some goods that were slowed down because of COVID in terms of deliveries and so on. So I think what's going to happen, and what is happening, is there's a higher percentage of small companies that are going to be closer to their maximum borrowing amounts on their lines of credit, okay? So, and yet, when you want to make hay while you can, right? So if things are going well, you don't want to hey, I can't do any more business because I'm sort of maxed out on my credit line. So one thing that we see as an opportunity is to basically if it's a company that's making money and it's a good company, they just need more money to fulfill more orders or whatever, we can to use a really simple example, if somebody had a $1 million line of credit and their credit limit and their balance is about $900,000, just to keep the math really easy. Yeah. What we would suggest is looking at borrowing $900,000 as a term loan, okay, off to the side, paying down your line of credit from $900,000 balance down to zero, and all of a sudden you have $900,000 more of working capital available to you. Okay, so it's just, you have to be profitable to do that, right? Fairly profitable, because you're basically taking a line of credit balance and allowing the business to pay it back over a few years instead of just when they collect the next receivable. But it's a good strategy.
Nice. What about SBA loans?
That is the SBA loan. Using an SBA guarantee will make it easier for us to approve that type of loan for businesses. So often that scenario that I painted will utilize an SBA guarantee because that makes us more lenient with how much money we can loan to that business. So that's
on the safe side.
Stay on the safe side, but it's really very, very effective. I mean, if you think about it, we can essentially double the amount of working capital available to a business. If they have $1 million line and $1 million balance, you can pay that $1 million down to zero, and they have an extra $1 million. So now they have $2 million in availability instead of one. It is very effective.
And this is priceless advice. Thank you very much.
Yes.